Welcome to the deep dive. Today, we're cutting through the noise and really getting into the comprehensive Q3 2025 results from MFC, one of the world's biggest financial services leaders.
That's right.
Our mission here is to give you that shortcut. We want to help you bypass all the dense reports, all the jargon, and just extract the core financial health, the global strategy, and, what's really driving their performance.
And the headlines here are genuinely strong.
They really are. This wasn't just a good quarter. It was a quarter with record core earnings and some pretty significant double-digit growth in core earnings per share.
It absolutely was.
Right.
I mean, when you dig into the financials, the foundation looks incredibly solid. Core earnings hit $2 billion.
$2 billion.
And that's up 10% on a constant exchange rate basis or
That's-
CER. Then you have core earnings per share, EPS, at $1.16, which is a 16% jump.
Wow.
But for me, the most compelling number, the one that really tells you about the efficiency of their returns, is the core return on equity. The core ROE hit a remarkable 18.1%.
18.1%. I mean, that is far above what we typically see for a major insurer, and certainly ahead of most banks. It really speaks to high-quality growth.
It does.
So, where are they aiming all this financial firepower? Let's talk about their strategic blueprint.
Okay.
The company has sort of kept this philosophy of global diversification, but this Q3 update makes it clear they are sharpening their focus on some very specific high-octane growth areas.
Exactly. They are explicitly emphasizing Asia and global wealth and asset management, or global WAM. They're calling them compelling growth opportunities.
So that's where the focus is.
Right, but they still need that balance. So they're committed to investing in their foundational Canada and U.S. markets, but the real strategic growth capital, it's clearly flowing east and into asset management.
Is this a true pivot away from North America, or is it more of a relative reprioritization?
I'd say it's a relative reprioritization. They need the stability and the scale of the U.S. and Canada, but the future growth really hinges on getting those higher returns from Asia. And you can see this reflected in their big moves this quarter.
Okay, so let's talk about those. What are the big geographic and capability moves they made that really underscore this strategy?
Well, the biggest geographic headline has to be the move into India. They announced a plan to enter the Indian insurance market.
A huge market.
Huge. It's a 50-50 life insurance joint venture with Mahindra and Mahindra. India is the world's most populous nation, and the insurance market there is still vastly undersaturated. This is a massive long-term bet, though it is still subject to regulatory approvals.
Got it. And on the capability side, particularly in global WAM, which seems to be a growth area for everyone right now, what did they buy?
Two really critical acquisitions. First, they snapped up Comvest Credit Partners. That's a U.S. private credit manager with a nearly $15 billion platform.
So private credit.
Exactly. It's a crucial move to enhance their private credit capabilities, a very high-margin area. And second, they agreed to acquire Schroders Indonesia. That move will immediately make them Indonesia's largest asset manager.
So that's geographic expansion plus high margin capabilities. But the strategy also seems to rely heavily on technology. They even state their objective is to become an AI-powered organization. How are they getting past the buzzwords and actually deploying AI?
They're using it for both external customer service and internal efficiency, which is where the real cost savings are. Externally, look at their AI assistant chatbot in Hong Kong.
Right.
It's 24/7, it's multilingual, and it handles complex claims and policy inquiries. That massively reduces pressure on human call centers. Internally, they launched a Gen AI-powered coaching tool in Canada for their insurance supervisors.
Interesting.
Yeah, it uses data to generate personalized, effective feedback. It's really about making their human distribution force more efficient.
Okay, that sets the stage for future profits. Before we jump into the segments, let's look at the forward indicators. The top-line insurance sales. Are people actually buying more policies?
Oh, absolutely. The sales momentum is robust, and that feeds directly into future profitability. Total annualized premium equivalent, or APE sales, increased by 8%.
And what about the value metrics?
Even better, new business contractual service margin, or CSM, soared by 25%.
And for you listening, that CSM is probably the single most important metric under the new accounting standard. So what does a 25% jump in CSM actually mean?
Well, think of CSM as the estimated future profit stream that gets locked in when you write a new policy. It's not cash today, but it's the high-quality, long-term profit the company is guaranteed to earn.
So a 25% jump means the quality and volume of the business they wrote was dramatically better.
Exactly. It highlights profitable sales execution. And new business value, or NBV, which is related, was also up a strong 11%.
Excellent. With that sales momentum set, let's check the report card for the seconds. And a crucial piece of context here is that 76% of their year-to-date core earnings now come from those highest potential businesses, Asia and Global WAM.
That 76% figure really confirms the strategy is working where it matters most.
Let's start with Asia then, the undisputed growth leader.
Asia's core earnings were massive this quarter, up 29% on a US dollar basis, hitting $550 million. APE sales rose 5%, and NBV was up 7%.
And where's that growth coming from?
The engine isn't just one market. It's volume growth across what they call Asia, and so markets outside of established hubs like Hong Kong and Japan. And the improved NBV margin up to 39% shows they aren't just chasing volume.
That 29% earnings growth is huge. It completely justifies the strategic focus.
It does.
Okay, let's turn to Global WAM. This segment presents a fascinating contrast. We see incredibly strong margins, but some challenging client flows. What gives?
Global WAM core earnings grew 9% to 525 million Canadian, and that was supported by rising markets and really tight expense control. The core EBITDA margin expanded significantly by 310 basis points to almost 31%.
That's a big margin expansion.
It is, and it suggests they're managing their existing asset base highly efficiently. That's the strength.
Now for the twist, the segment had net outflows of 6.2 billion Canadian dollars. That's a substantial reversal from the 5.2 billion in inflows just last year.
It's a stark contrast.
So how can margins expand while clients are pulling billions out?
That is the core tension here. The margin is strong because it reflects the performance of their existing assets, the AUMA, which actually grew 10% year over year thanks to good market returns. But the outflows signal a client retention challenge. It's primarily driven by the retail segment, North American intermediaries, and their Canada Wealth platform. Clients are just choosing other products or moving money out of active management.
So we have an asset manager that's highly profitable on its current book, but it's struggling to attract new money in certain channels. A key distinction for you to note. What about on the domestic front? How did Canada perform?
Canada delivered its usual solid domestic performance. Core earnings grew 4% to 428 million. The sales momentum was strong, particularly in individual insurance, pushing APE sales up 9%.
And CSM.
New business CSM was also up healthy 15%. So, stability and good growth at home.
And finally, the U.S. segment. This looks like the quarter's biggest mixed bag. It shows major challenges and massive future opportunities all at the same time.
It's definitely the most volatile part of this story. The immediate headwind was a 20% decrease in core earnings, which fell to $241 million US dollars.
And what caused that drop?
It was primarily due to unfavorable life insurance claims experience and lower investment spreads.
Wait, a 20% drop in core earnings is massive. Even with the company's broader success, does that kind of claims volatility introduce a lot of risk into their quarterly forecasts? Is this structural or just temporary noise?
That's the critical question, right? Management implied it was noise, but the severity of the claims experience is something to watch. However, the future picture for the U.S. looks exceptionally bright.
How so?
Despite the current earnings hit, the sales growth was phenomenal. APE sales were up 51%. New business CSM was up a staggering 104%.
Wow, 104.
And NBV was up 53%. So they're selling products that are locking in tremendous future profitability, even while they absorb these short-term shocks.
That's a perfect transition. We've seen the sales and segment volatility. Now let's look at the financial engine room, the balance sheet, and the actuarial assumptions that ensure long-term stability.
We have to start with their annual review of actuarial methods. It's a huge exercise. And the net result was actually favorable. It translated to a $605 million decrease in pre-tax fulfillment cash flows. Good news for the balance sheet.
But the big item everyone watches is U.S. long-term care, or LTC. That business has been a huge drag for so many companies. Did their review force them to take a big charge?
Surprisingly, no. The LTC review resulted in a roughly net neutral impact on fulfillment cash flows.
Net neutral.
Which is noteworthy because the business saw higher utilization from cost of care inflation. That should have created a negative impact.
So how did they achieve neutrality despite expecting higher claims?
They did it by relying heavily on future regulatory actions. To balance the books, the company embedded 1.1 billion US dollars of assumed future premium rate increases into their cash flow models.
1.1 billion.
Yes. So essentially, they're banking on getting permission from regulators across various states to hike customer premiums by that amount over time.
So you're shifting the risk. It's no longer just actuarial uncertainty, it's now political and regulatory risk. That's a pretty significant assumption to carry.
It is. If those rate increases don't fully materialize or on time, that net neutral status of the LTC business evaporates pretty quickly. It just trades one type of risk for another.
Right. And shifting back to immediate experience, we already noted the adverse claims in the U.S. What was the overall insurance picture?
Overall, net unfavorable insurance experience resulted in a $55 million pre-tax loss, driven mostly by that mortality experience in U.S. life. However, on the credit risk side, the change in expected credit loss, or ECL, was a release of $44 million pre-tax,
Which is a positive.
a very favorable contrast to the charge they recorded last year.
Okay, finally, let's wrap up with the capital position. Is the company stable enough to carry this aggressive growth strategy forward?
The balance sheet is rock solid. The regulatory II-CAT ratio is robust at 138%. Their financial leverage ratio is improving, down to 22.7%, which is safely below their target.
And the CSM balance?
Crucially, that contractual service margin balance stood at a healthy $24.7 billion, and it's generating 11% annualized organic growth. This is that pool of future profits, and it's expanding rapidly.
And what does this all translate to for shareholders?
Strong returns. Adjusted book value per common share increased 12% year over year, and the dividend per common share was up 10% to 44 cents.
So if we synthesize this whole deep dive, the Q3 results show a company in really aggressive execution mode. They're using tech and acquisitions in high-potential markets like Asia, driving new business value, while managing these complex but localized challenges in North American insurance claims.
Precisely. They are executing that strategic transition effectively. They're focusing growth capital on high-margin areas like global WAM and Asia, and that 76% earnings contribution figure confirms it. The core strength is undeniable, but that underlying volatility, especially in U.S. claims, it requires ongoing vigilance.
And here is a final provocative thought for you to consider. We noted that the stability of the long-term care business is now heavily reliant on achieving that massive $1.1 billion in future premium rate increases. If the company is unable to secure even half of those mandated rate increases due to regulatory pushback, what immediate or delayed impact does that shortfall have on their ability to continue funding the highly profitable growth strategies in Asia and private credit, forcing a potential trade-off between shoring up a legacy business and executing the future plan?